It's basically we will start today IAS 38 intangibles, very important standard. I think every exam has a question on this standard. Even the current examination also contains, I think, 10 to 14 marks of the question containing this standard. So it's very important, and for a long time, it's been a very favorite accounting standard for the examiner. And its application is very wide and very, basically, it deals with the ever-changing environment which we are basically facing right now, technological environment, innovative environment, complex environment. So this standard deals with a lot of many innovations, technological changes, and IT. So that's why this standard is very important for us. If we started, so first of all, we have to look around what is the definition of the intangibles. IAS 38 intangible accounts the accounting treatment for intangibles, which are non-monetary assets, being without physical existence and are identifiable. So here comes the three main points. Number one, how you will distinguish intangibles from other assets. Number one, they are the assets without the physical existence. Number two, they are non-monetary in nature. And number three, they are identifiable. So these are the three main characteristics of IAS 38 intangible. We'll discuss it in detail now. If we look upon the first characteristic, that is physical existence, non-physical existence, I think you already know it. The second one is very important, non-monetary in nature. Basically, you heard about these items, that there is a difference between non-monetary assets and monetary assets. Now, what are the non-monetary assets? Non-monetary assets are those assets whose benefits are not determinable precisely in dollar terms. Or we can say these are the assets which are not easily convertible into cash. Now, what are the monetary assets? These are the assets whose benefits are precisely determinable in dollar terms. And second one is they can be easily convertible into cash. Take an example. Take an example. Plant. You bought a plant at a cost of 100 million. Now, can you guess that this plant will give us how many benefits? The amount of benefits which this plant will give. This plant may give us 99 million benefits. It may be 110 million, it may be 90 million, it may be 105 million. We cannot guess the precise amount of the benefits. So that's why we can say that plant is basically non-monetary in nature. Similarly, if we have a building, we bought a building for 100 million. Can we guess precisely how much it will give us? No. It can be sold for 110, it can be sold for 90, it can save us 10 million, it can save us 15 million. So this building is also of non-monetary in nature. Inventory. We bought an inventory or raw material, cost 100 million. Now inventory is basically for ordinary purpose sale. But can you guess the amount, precise amount, that how much it will give us? You will basically ask that, sir, basically its selling price is predetermined. We sell our inventory at a predetermined selling price. But again, I am asking, are you sure that you will be able to sell this inventory at that selling price? It will be decided at that occasion when you will sell that. For example, right now, I have a predetermined selling price of $10. But when I will basically go into the market and sell my inventory, maybe I will not be able to get $10. I will be able to get $9.5. Maybe I will get $10.5. So I will not be able to precisely predict what amount of benefits I will get. So inventory is also of non-monetary in nature. In short, what I am basically telling you, all physical assets are non-monetary in nature. All physical assets. So we can say IAS 16 PPE, IAS 2 PPE, IAS 40 investment property, IAS 41 agricultural. These all are basically assets of non-monetary in nature, because we cannot predict, we cannot estimate their benefits in dollar terms precisely. Now we are left with only intangibles. We already decided that tangibles item, whatever they are, all the tangible items are of non-monetary in nature. Now we are left with intangibles. There are two types of intangibles now. One, monetary intangibles, and other, non-monetary. Now, the non-monetary intangibles are basically dealt under IAS 38. And monetary intangibles, they are basically dealt under the standards of financial instruments. Which is a very long list. It contains almost 4 standards of this area, financial instruments. But right now, we are basically discussing non-monetary intangibles. So which standard we are basically dealing with? IAS 38. Now, what is the definition of monetary asset? Whose benefits are precisely determinable in dollar terms. For example, cash. You have a cash of 100 rupees, $100. How much benefit you will get? 100. Because cash means the exact amount, the benefits you get. Same is the case with receivables. If you have the receivable figure of 100, how much cash you will be able to get? How much benefits you will be able to get? 100. Okay, next, add one thing in the definition of monetary assets whose benefits are precisely determinable in dollar terms and or their benefits are linked with revenue or profits. What is the meaning of this? If we take an example, we have an investment in subsidiary. We bought 60% shareholding in that subsidiary and we bought that shareholding for 100 million. How much benefit we will get? Not sure. That subsidiary will generate, we don't know how much it will generate in the future. But one thing we know is the subsidiary generate any kind of the benefit. Of those benefits, we will get 60% benefits. So now there is a twist in the definition of monetary asset. Number one, that is, we basically determine the nature of asset. We basically determine the nature of monetary asset on the basis of amount of benefits they give. Number two, we can also predict them on the basis of percentage of benefit they give. In case of subsidiary, they give like 60% of the benefits. Now, whatever the amount of revenue or profit the subsidiary will earn, parent will get 60% of this. Same is the case with if we have an investment in associates. Similar, what amount associate will generate, we don't know. But what we know is that we will get the 40% share out of it. Similarly, the third category of the investments are other investments. What are other investments? These are the investments in which our shareholding is basically less than 20%. Now, again, applying this situation over here, we can predict that whatever the amount this investment will earn, we will be able to get 20% out of it. But on the other hand, if we look into the examples of non-monetary assets which fall under IAS 38, for example, you bought a brand, 100 million. How much benefit it will give you? We don't know. So brand is of non-monetary in nature. You bought a goodwill. You bought a subsidiary, and with that subsidiary, you bought a goodwill of 100 million. So what amount of benefit that goodwill will give you? We don't know. We cannot determine it price precisely. So this goodwill is also of non-monetary in nature. Similarly, we develop a technology of 10 million. How much benefit it will give? Again, it is of non-monetary in nature. So all those items, take an example of a franchise agreement. We bought a franchise of 10 million. Again, we don't know what amount of benefit this franchise will generate. So again, this will be treated under non-monetary in nature, IAS 38. We bought a license from government to extract an oil. What kind of benefit we will be basically generating? No, we cannot determine. Quotas. Quotas are basically the share which we bought from government to import certain kind of material. For example, there is a limit to import material X in some country. Our company will buy a quota. Quota means the share from government, that the whoever will get this quota will be able to import X percentage of this material X. So this quota will cost us, let's say, $10 million. Again, this is of non-monetary in nature. So now I think I have made very clear to you the difference between monetary and non-monetary assets. I will remind it. Number one, first of all, I will differentiate between non-monetary and monetary assets. Non-monetary assets are those assets whose benefits are not determined precisely in dollar terms. Number two, they are not easily convertible into cash. And monetary assets, these are the assets whose benefits are precisely determinable in cash, in dollar terms, or their benefits are linked with revenue or profits. All tangible assets are non-monetary in nature. Rest we are left with intangibles. So there are two types of intangibles. One are monetary in nature and others are non-monetary in nature. All the monetary intangibles are dealt under financial instruments like cash, receivables, investments. They are all examples of monetary assets. And the intangible monetary assets, non-monetary assets are brand, technology, franchises, licenses. Okay. If we basically look into the detail, what I already write over here, which are not easily convertible into cash. Take an example. We have a plant. Now, can you convert the plant into cash easily? Let's take an example. Can we convert plant easily into cash? No. Number one, we have to produce some goods from that plant, and that goods will be sold to customers on credit. That will generate receivables, and then we will receive cash. So this means plant is not convertible easily into the cash. The other option is, can we sell the plant directly? Answer is no, because basically we are not selling plant as a main business portion. Basically we are selling it, our main business is to sell our inventory, and plant cost is very high, its selling price is very high, so we cannot expect that our customer will pay us directly into the cash. He can pay us, any business can pay us in cash, but I am basically talking generally. Generally, the businesses when they sell their plant, building, or some other fixed assets, non-current assets, they are not able to receive cash directly. They have to wait for it. Similarly, if we have an inventory, now one question will definitely hit your brain, that inventory is directly convertible into the cash. Answer is big no. Answer is big no. Why? Because first of all, inventory will be sold and it will be convertible into receivables. That means inventory is not easily convertible into cash. Now from receivables, it will be convertible into cash. So there is a big difference between monetary assets and non-monetary assets. Now take an example of receivables. Receivables, on the other hand, is an example of monetary assets. And from receivables, they are directly convertible into cash. This is an example of monetary asset. This is an example of non-monetary asset. This is this example I am showing you. This is the difference, that in case of non-monetary asset, asset is not directly convertible into cash easily. But in case of monetary asset, it is convertible into cash easily. So this basically, this was the main difference between these two. Okay, now any question regarding these two items, monetary assets versus non-monetary assets? Yes. Yes, please, you can ask it.
सर थोड़ा कंफ्यूजन हो रहा है क्योंकि अगर हम कुछ भी बेचते हैं ना, फॉर एग्जांपल इन्वेंट्री डायरेक्टली हम कैश बेस पर भी बेच सकते हैं और बिल्डिंग को भी ऐसी
Basically,
कैश
we
बेस।
are basically talking about the international reporting standard, which is mandatory for the businesses, and the businesses or manufacturers, they are basically, they deals with the customers on credit basis. Okay,
ओके ऑलराइट।
they basically don't deal with their customer on the cash basis, and any small business which deals with cash customers is not mandatory to apply the accounting standard. These accounting standards are only mandatory for public limited companies, and all public limited companies are basically selling their goods via some distribution channel or via some receivables. They are not directly selling it to the customers on retail basis. Okay, so this is the difference.
सही।
Any other question, please?
थैंक
Any
यू
question?
सर।
Yes. Is it clear now the difference between monetary assets and non-monetary assets?
यस सर।
Okay. Let's move onwards. Identifiable. Identifiable means the asset arises from legal or statutory rights / contractual rights. Number one. Number two, separable. The asset must be separable. Now, what is meant by separable? Separable means that asset can be bought or sold separately into the market. So this is the main point in the definition of intangibles, identifiable. Remind it, intangibles are the items without physical existence, non-monetary in nature, and they are identifiable. Now, we are basically discussing what identifiable means. Identifiability means the asset arises from legal or contractual rights. Number one. Number two, and they are separable. Now, take an examples. First, we already decided that intangibles are non-monetary in nature. Now I am discussing only non-monetary intangibles. But all non-monetary intangibles will not fall under IAS 38. Do keep in mind, not all intangibles, non-monetary intangibles will fall under IAS 38. In order to qualify for IAS 38, those non-monetary intangibles must also be identifiable. They must meet the criteria of identifiability. Example, we bought a license of 100 million from government. Now, this license gives you the legal rights to receive benefit. Number one, governments sell this license independently, separately So this license is also separable. So we can say license falls under IAS 38. One more example. We bought franchise 100 million. Franchise gives us contractual rights to receive benefits. And franchises are sold and bought separately. So franchise is also separable. Third example, goodwill. If we bought a goodwill of 100 million, we have a contractual rights to receive benefits, but goodwill is not separable because goodwill cannot be bought or sold separately from main business. Whenever the whole business will be sold, goodwill will be basically also sold. So if we buy any business, we have to buy its goodwill as well. We cannot buy the goodwill of the business separately from main business. So we can say that goodwill is not separable. That's why goodwill, despite the fact that it is non-monetary in nature, it falls under IFRS 3 business combination. So mind it that goodwill is basically non-monetary in nature, but due to non-separability, it will not fall under IAS 38. It falls under another standard called IFRS 3 business combination. But we can say that the guidelines of IAS 38 will apply on goodwill because the nature of goodwill is non-monetary in nature. So all those standards, all those assets which are of non-monetary in nature and they basically are not into the IAS 38 category will have a basically direct link from IAS 38. IAS 38 guidelines will be applied on them as well. Like what I said earlier, that goodwill belongs to IFRS 3. Standard IFRS 3 will be applicable on goodwill. But the main guideline which also applied on goodwill will be from IAS 38. So this is the difference between identifiability, separability, and non-separability. Take another example. You bought a quota from government of 10 million. Tell me, anyone, quotas of 10 million. Is this quota identifiable?
Yes, sir.
How? Explain it.
Be- Because it's been sold from the government to import some goods, so I think it is legally acceptable for.
Basically, it will give you legal rights.
Yeah.
Legal rights to receive cash or benefits, and it is separable. So it falls under IAS 38. Okay. Now I am basically discussing more complex situation which you will face in your exam. So focus on it. Contractual rights. What are contractual rights? These are the rights to receive benefits arises from any contract, which arising from any contract. So contractual rights are non-monetary in nature. They may be monetary in nature. Yes, all contractual rights will not fall under IAS 38. All contractual rights will not fall under financial instruments one by one. Franchises. Franchise is an example of contract. It will give you contractual rights to receive benefit, but the amount of benefits it will generate, we cannot predict, we cannot estimate them precisely. So franchise falls under non-monetary in nature, and IAS 38 will be applicable. On the other hand, receivables, if we have a receivable of 100 million, these receivables give us contractual rights to receive 100 million. But in case of receivables, we are sure what amount of benefits we will get in dollar terms. So these receivables will fall under monetary assets, and the standards applicable on them will be of financial instruments. Okay, now you tell me, perpetuity. You bought a perpetuity of 10 million. Which standard we will apply on this? IAS 38 or monetary financial instrument standard? Yes, anyone? Yes? Are you hearing me? Hello? Are you hearing me? Okay. Perpetuity means any contract we have contractual rights to receive fixed payment for indefinite time period. We cannot predict the total amount we will get from this contract. So perpetuity will fall under IAS 38 intangibles. On the other hand, if we bought an annuity, annuity means we have a contractual rights to receive fixed payments for definite time period. So here we know for how long we will be able to get these payments. So we can precisely determine the amount of benefits which we will get from this investment. So annuity will fall under IFRS 9 financial instrument. Another example, take another example. A club, football club, bought a player, Mr. X, for $10 million. How will you treat this contract in your accounts? You are an accountant from football club. Now, the contract gives football club contractual rights to receive benefits. Number one. Number two, it is also separable. Contracts can be sold or bought separately. And number three, how much benefits it will give, we cannot determine it precisely. So these, the player contracts, these are called players contracts. Players contracts fall under IAS 38. But if football club has a contract with Mr. A very famous player, 20 million, and this contract will make sure that 25% of the match revenue will be due to Mr. A. This means crowd will come into the ground due to Mr. A, and 25% of the total revenue generated from the crowd will be due to Mr. A. So this contract now will be treated under monetary assets, financial instruments. We have two contracts. First, we have a contract with Mr. X, 10 million. We bought this player contract for 10 million, but we are not sure what amount of benefit it will give us. Mind it that I discussed it earlier, the definition of monetary asset, the amount of benefits can be determinable in terms of percentage as well. So the contract with Mr. A will give the benefit of 25% to football club. At least we are sure that 25% of the total revenue will be generated from this contract. So we can easily basically predict that the contract with Mr. A falls under financial instrument, monetary assets. So this is the basically discussion of the definition. Why I discussed it in so much detail? Because you have been given a question in an exam on this standard will be basically on the definition issues. Students often are not able to distinguish between monetary assets and non-monetary assets. They often do not able to distinguish between identifiability and non-identifiability. So now if we move onwards, what are non-monetary assets? Non-monetary assets are the assets a company holds for which it is not possible to precisely determine a dollar value. I think it is now clear to you. I have discussed it a lot that if you are not able to predict the dollar benefits precisely, then these are basically example of non-monetary assets. These are the assets whose dollar value may fluctuate and that changes substantially over the time. Suppose we have a cash of 100 million. The value of 100 million cash will not fluctuate over the period. Take an example. I have a $100 in my pocket of 1990. Okay. I have a note of $100 in my pocket of 1990. Now, what value it will give me today? Its value will be the same because it's written on that note that it is of $100 note, and whenever I will go into the market, I will be able to cash it and may be able to get the benefits equal to the $100. But on the other hand, if I have a gold which I bought in 1990 for $100, that gold is not of $100 worth now. Its value fluctuate greatly. Its value change a lot. Now maybe that gold worth $1,000 now. So from that you can easily guess that the value fluctuates. When the value fluctuates, it is not of monetary nature. This means that asset is of non-monetary nature. But whenever the value of asset remains constant, it is of monetary in nature. For example, you bought a building in 1970 for 10,000. It worth now 10 million. This means the value of the building fluctuates greatly. So this building is of non-monetary in nature. You bought a raw material 15 months back. The value of this raw material fluctuates. So we can say that inventory is of non-monetary in nature. And the assets that are not readily or easily convertible into cash or cash equivalents. Monetary assets, non-monetary assets are thus distinguished from monetary assets, which include cash and cash equivalents such as cash on hand, bank deposits, investment accounts. I have already given you a lot of examples of monetary assets. Typical non-monetary assets of company include both intangible assets such as copyrights, design patents, goodwill, and tangible assets includes PPE, assets, and inventory. All physical assets are of non-monetary in nature. IAS 16, 2, 40, 38 are all of non-monetary in nature. Monetary assets falls under financial instruments. The standards are IAS 32, IFRS 7, IFRS 9. Goodwill qualifies for non-monetary assets but will be dealt under IFRS 3, which I discussed already. Why goodwill is not accounted for under IAS 30? Because it is not separable. And that's why it is being dealt under another standard called IFRS 3 business combination. Examples of non-monetary intangibles are copyrights, purchase, brands, patents, design, own brand, technologies, softwares. These are all examples of the non-monetary intangibles which fall under IAS 38. If we move onwards, now we have discussed what is the definition of IAS 38. The next step is when to recognize them in our financial statement. In order to be qualified for SOFP, Statement of Financial Position, these intangibles must meet the following recognition criteria. There are 4 criteria. Number 1, asset is identifiable. Now I think you must learn it. What is identifiability? Identifiability means asset arises from legal or contractual rights. Number 2, they are separable. The second condition is the asset is controlled by an entity. You know what is the main problem with intangibles or the assets without physical existence? The asset with physical existence are easy to control, but the assets without physical existence are not easy to control. Take an example. If I have certain idea in my mind and I am basically working on it to develop a new product, but someone around me can catch my idea and produce its own goods, his own goods. So this means that on the intangibles, you have no control. Third one, The asset will generate future economic benefits for the entity. And number 4, the cost of asset can be measured reliably. So these are all the 4 criteria which must be met in order to qualify for financial statement. An intangible asset is identifiable if it is separable and if it arises from contractual or legal rights. I already explained it in detail. If an intangible asset does not meet the recognition criteria, expenditure should be charged to statement of profit and loss as it incurred. Once the expenditure has been so charged, it cannot be capitalized at a later date. Very, very important point. Okay, take an example. In order to qualify for why intangibles fail to qualify for SOFP recognition, there are 2 main reasons. Number 1, they have certain valuation problem. Number 2, there may be some control problem. Valuation problem. Examples. Own brand. Business has its own brand. Now, what value will it put on this brand? This brand is basically not for sale. This is a running brand, and its value cannot be predicted, because its value will only be determinable if this brand is sold in the market. So this means if we put a value of 10 million on it, our competitor or our market will basically criticize us that this brand is not of more than 6 million. So this means we have a valuation problem. So all the internally, these are called internally developed intangibles. Majority of them have valuation problem. So own brand, they have valuation problem. Skills. For example, a person is having a certain skills. Now, what value of those skills will he receive? We cannot basically estimate it. We cannot value it. So again, skills are of valuation problem. Skills cannot be valued. Knowledge, even own goodwill. This is very important point. This example is often being asked in the question of exam. The business own goodwill. You already knew that you recognize the purchased goodwill in your SOFP. When you bought a subsidiary, you also buy the goodwill of that subsidiary. The goodwill of that subsidiary will be recognized in SOFP. But what about the goodwill of parent? Why we do not recognize the goodwill of parent in consolidated financial statement or in parent's financial statement? The answer is because the parent's goodwill is own goodwill. The parent's goodwill is internally developed goodwill. It has a valuation problem. And any intangible which has an valuation problem, they will not be recorded anywhere. No recording. So now clear your concept about goodwill. You already knew in your previous paper, from your previous papers, that goodwill is always impaired. Why didn't you ask this question? Why the goodwill is always impaired? Why goodwill is not revalued upwards? Why it is always impaired? This question must strike your mind, that why we always impaired our goodwill. The answer is very simple, but according to the principle which we already discussed, that once goodwill is which goodwill? Once purchased goodwill of subsidiary is recognized in financial statement, it becomes internally generated. After the acquisition, the goodwill of subsidiary and goodwill of parent becomes internally generated. Now there will be no difference between these two goodwill. Now we will basically discuss the goodwill of group as a whole. So now this goodwill becomes internally developed. And what kind of problem we face due to internally generated intangibles? Valuation problem. So due to valuation problem, we cannot revalue the goodwill. The subsidiary combines with the parent, and the group as a whole is performing very well. As you know, that if a group is performing very well, definitely its goodwill will also rise. But that goodwill which already rise due to this combination will not be recorded in SOFP. Why? Because now that goodwill is considered as internally developed. So that's why even if after the business acquisition, goodwill, if there is an increase in goodwill value, we are not able to record it because IAS 36 and IAS 38 prohibit us. But yes, why we impair the goodwill? The question remains there. Why we impair it? Any capital expenditure in SOFP is ultimately transferable to profit and loss. This is the basic theme of accounting. If you understand this theme, that any things, any items which are basically disclosed in SOFP are eventually transferable to profit and loss. So where we recorded our goodwill? We recorded our goodwill in SOFP. Now we have to transfer this 100 million goodwill in profit and loss by two methods: by amortization or by impairment. In some jurisdictions like USA GAAPs, goodwill is normally amortized, but basically we are following IFRS's amortization of goodwill is not allowed. Now we have to apply impairment tests or impairment on goodwill. So by applying impairment test and by charging impairment loss to goodwill, we are transferring the goodwill amount in SOFP to profit and loss. I think now I have given you enough details about why we are not able to revalue our goodwill, why goodwill is always impaired. Any question up till now? Yes? Any question?
No, sir.
Okay. Note that the accounting treatment of goodwill arising on business combination is dealt with in IFRS 3 business combination rather than IAS 38. Purchased intangibles will always qualify for recognition criteria. This is very, very important point. Purchased intangibles will always qualify for recognition criteria. I will give you an example. Internally developed intangibles will not qualify for criteria due to control problem or valuation problem. This I already explained it to you. Now I'll give you an example that in, I think, paper 2012 or 13, this question is in your revision kit. A company bought a compound or a chemical formula for 10 million. But company is not sure how much benefits will this compound generate. On the basis of this, company has not yet concluded the benefits of this compound. This question was of 8 marks. I think more than 8 marks. It was of, I think, 10 marks question. The whole question contains some other points as well. Now, the main thing here, which basically confused the students, was the statement given in the exam. And that statement was, the company is not sure how much benefits it will generate. The second statement, that company has not yet concluded. Now, every student thought that the inflows are not probable. So the basic criteria of recognizing the asset in SOFP is that asset must generate economic benefits. So that's why majority of students thought that this brand must not be recognized in SOFP, and they made a mistake. Why? Now, I think in your mind, you also thought like this. Yes, isn't like this?
Yes, sir.
Okay. Now, what is the answer? What is its answer? You bought this for a value of 10 million. Is this the market value or estimated value? Answer this.
Market value.
How you come to know?
Because it is the price that you have bought from the market.
Because we bought this for this, because we bought this compound at this value.
Yes.
Now, why market has placed 10 million price on that compound? Yes, answer me. Why market has placed 10 million value?
Because this is the market value. This is the exact value that
No, no, no,
the
no, no,
asset.
no, 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 no. What I am asking is why market has placed the value 10 million of this compound. Why? Simple answer. Because market expects that this compound will be able to generate 10 million at least benefits. Simple.
Yes.
If you have a 1 kg potato price of 100, then this means that market is expecting that this potato will basically generate 100 benefits to the customer. So simple is that. The market value means that market expects that this asset will generate 10 million of benefits. Now, it is the inefficiency of this company that it is not yet able to conclude the benefits, or it is the fault of this compound that this compound will not generate the benefits. Tell me. Will you consider this that it is a fault of the company that it is not yet been able to conclude the benefits of that compound, or it is uh, the fault of the compound? Let's say it is the fault of the compound that it will not generate or get so much benefits. Definitely it is the fault of the company. You cannot blame the compound. Why? Look here, see, there are mainly two reasons why we are basically discussing it. Number one, is this the mistake of the company? Number two, is this the due to the nature of this compound that its benefits has not yet been concluded? Second one, first we will answer the second one. If it was due to the nature of the compound, then why market has put a value of 10 million on it? So this means that this compound has a potential. This compound has a potential of generating 10 million. Then why we have not concluded the benefits? This means this was our fault. This means that our management is not efficient. This means that our management is not basically taking it efficiently, or making its decisions efficiently. That's why it is not being able to predict the benefits generated by this compound. So you will discuss this in the paper, and you will discuss it that it was the market which placed 10 million value to this compound, as market is expecting at least this much benefits from compound. So if company is not yet able to conclude the benefits of compound, it may be due to the inefficiency So now what you must do, recognize this compound in SOFP at 10 million. I am just giving you the examples which were already being asked in your exam paper. Just focus on it. There will not be simple, straightforward scenarios. There will be a lot of complexities in those questions. You maybe you will be able to face the questions in which the accountant has already made a mistake and you have to rectify those mistakes and apply the accounting principle and relevant accounting standard. In some questions you may be able to ask what mistakes the accountant has made and how to rectify them, and what principles you will apply on them. In some questions you will not be able to analyze or judge that it is being correctly accounted for or it is being incorrectly accounted for. Whenever you are confused with certain type of the question, just go to your basic, just identify the accounting standard which you have been asked for, write that accounting standard, apply the principle on situation, and produce your answer yourself. That will give you enough marks. So you will be basically involved in different complex situation in your exam. It will not be an easy exam. You have to prepare it from now. You must basically look into the notes, look into the notes, uh, and must listen to the lectures, and must focus on the topics and concepts which I am trying to give you. Okay, any question now? Yes.
No, sir. Thank you.
Okay. Internally developed intangibles with control problem will be expensed. Examples would be marketing, staff training.
So what
If
does it mean like a control problems?
I am giving an example. Suppose you have some brilliant idea in your mind and you share that idea with your friend. Will you be able to control your friend that he will not leak your idea to anyone?
No.
So this means all intangibles are basically uh, prone to control problem because of their non-existence. Okay, because of their
Okay.
non-existence they are prone to the control problem. Now I am giving you an example. Marketing expenditure, you incurred 10 million.
Okay.
For whom you are basically doing the marketing? For whom?
For the own company?
For customers. No, not for your not for company. It's for customers, to attract customers.
Yes, yes, sir.
Now do you have any control over customers?
No.
So that's why we cannot capitalize marketing expenditure in SOFP. We will expense this in profit and loss. Now you understand it?
Yes, sir. But there's one question, sir, that is arising in my mind. Like, as earlier you said, the bought and like, the bought brands that we are buying the goodwills from the other companies, and we recognize it for the first year in goodwill, and it becomes as a parent goodwill, right?
Yes. Once you recognize the goodwill, it will become
Yes.
internally generated, and
So do
that goodwill will not be revalued upward, because we have a valuation problem of intangibles due to their non-existence.
okay. Do we expense them out like in the next year, like after 2 years or 3 years,
No. It is not.
or impair them out?
Basically, we will conduct an impairment test on goodwill annually according to IAS 36. which is very important standard in our study, in our syllabus, we will basically apply IAS 36 annually. Then we will see that goodwill, how much amount the goodwill has been impaired. If there will be no impairment, we will not impair that goodwill. Maybe first year we apply impairment test and it was concluded that no impairment loss is calculated. We will not impair that goodwill. In second year, we will apply again impairment test. Maybe in that year impairment of goodwill arises, we will charge impairment.
But
So
so once it is recognized as an parent goodwill, how could we able to impair them like in the next year?
basically, we are not recognizing parents' goodwill. We are recognizing only subsidiaries' goodwill. Okay? We are
Okay.
we are not recognizing the parents' goodwill in statement of financial position. We are just recognizing the subsidiaries' goodwill in our financial position statement. And mind you, that goodwill, basically we as a parent bought that goodwill for some amount. Isn't like that?
Yes, sir.
Now, this goodwill is of capital expenditure nature. Now, every capital expenditure must be transferred ultimately, eventually to profit and loss. Okay?
Yes. Yes,
Okay?
sir.
Now,
Yes.
that goodwill has two options in order to be transferred to profit and loss. One is to amortize it, other is to impair it. In IFRSs, we basically impair the goodwill. We do not amortize it. This is the situation number one. Now, basically what you are asking is, once the goodwill of subsidiary is recognized, that
Yes.
subsidiary now becomes a part of group.
Yes.
Now,
Exactly.
the parent goodwill will combine with that of subsidiaries goodwill.
Okay.
Now, can you be able to differentiate between the parent's goodwill and subsidiary goodwill? No. Let's say after 2 years of acquisition, we bought a goodwill 2 years ago of 10 million. After 2 years of acquisition, what amount we will be able to assign to subsidiaries goodwill? We do not know, because in these 2 years, parents goodwill combined with that subsidiary goodwill and they become internally generated. They become the group goodwill. Now, can we be able to value that goodwill?
No.
No, we cannot be able, because now it is a part of the goodwill. Basically, yes, there is one situation where this group goodwill can be calculated, and that situation is, tell me if you have any answer. There is only one situation in which the group's goodwill can be recognized, can be calculated. What that situation is, if you have any in mind.
No idea, sir.
If this group is ready for sale, if
Okay.
another group is basically acquiring this group, then that group will value the goodwill of this group as well.
Yes.
Now it is clear. But that is not the case.
Yes.
That is not the case we are discussing. We are just discussing if a business is in continuity, if business is in the running situation, its goodwill is internally developed, and that goodwill will not be recognized in SOFP. Only the goodwill of subsidiary that we purchased will be recognized. Clear?
All right, sir. Yes, sir.
Okay. Internally developed intangibles. Okay, I was discussing staff training. Tell me, you conduct workshops, training sessions, and some training courses for your staff, which cost you $10 million. Is there any certainty that your employee, your staff will not leak, will not uh, leak this training to anyone. Maybe he
No.
will be working for some other entity in the evening and will
No,
apply.
it's again control problem.
Yes, it's again control problem. So do keep in mind, there are two situations. Number one, internally developed intangibles with valuation problems will not be recognized anywhere. Okay,
Yes, sir.
but the internally developed intangibles with control problems, they will be expensed in profit and loss. Okay. Next,
Yes, sir.
internally developed intangibles in IFRS 3 business combination. Very important point. Upon acquisition by parent, the internal intangibles of subsidiary will be measured at fair value. If the fair value can be measured reliably, these intangibles will be recognized separately in balance sheet or SOFP. I'll give you an example. Suppose this is company A, this is company B. This company B has a net assets of 100 million recognized in SOFP. This company B has 10 intangibles not recognized. Why? Why these intangibles were not recognized in the SOFP of B? Why? Yes?
Maybe it is internally generated.
Yes, yes, yes. It is due to valuation problem
Yes.
because they are internally generated. Now, what happened? A acquired B. A is the parent. Now B becomes subsidiary. A becomes parent and B becomes subsidiary. A
Yes, sir.
put value on 7 out of 10 intangibles. Parent has given the value to 7 of the intangibles. Now, for 7 intangibles, valuation problem resolved now? Yes. Because they have been given a value by parent. And now the shareholder of the subsidiary will receive that much benefits in terms of consideration.
Yes, sir.
Basically, why we didn't recognize these 7 in our SOFP, because we are not sure what benefit or what value we can assign to this. But when parent acquired the subsidiary, parent put a value on these 7 intangibles. Now, 7 intangibles have been given a value by parent. These 7 intangibles now qualify for SOFP in subsidiary of subsidiary at fair value. The value that was given by the parent, that value will be separately disclosed in the SOFP of subsidiary. Now we are left with 3 intangibles. These are the intangibles which are not given a value by parent. Why? Because they are of so much specific nature that parent was unable to give any value to them. Now, these intangibles will be considered the part of goodwill. Just make it clear. Just make it clear. Where we are able to assign the value to an intangible, they will be disclosed in SOFP at fair value. But where we are not given a value by parent, then these intangibles will be considered part of goodwill. Now, from this discussion, we have come to the conclusion, a very brilliant definition of goodwill. What is the best definition of goodwill? The best definition of goodwill is the sum of all internally developed intangibles with valuation problem. Best definition. For example, tell me, if subsidiary has a brand and the parent has put 10 million on it, now what you think, this brand will be presented separately as an intangible asset, or will it be considered as a part of goodwill?
No, sir, it is a separate item, so we're gonna put in as an intangible assets.
Yes. What about skills? Skills, it will be considered as a part of goodwill.
Yes.
What about reputation?
Goodwill.
Goodwill. What about the in-house fighting between the management?
Again, reputation problem.
Yes, goodwill. Now you are clear? What I am basically telling you, that goodwill is the sum of all internally developed intangibles which are not given a value. For example, I take another example, knowledge. What do you think? Knowledge can be presented separately or goodwill? Goodwill. We cannot value the knowledge. Okay, we cannot value the knowledge. So basically, the difference here is which type of assets we have. Some assets will be given a value; these will be disclosed separately. Some assets will not be given a value; these will be considered as a part of goodwill. Clear?
Yes, sir.
Okay. I think we will discuss it tomorrow. From initial recognition, we will start from initial recognition, and we will start from here. Any questions from your side?
Thank you, sir.
Okay. Take care.
No
Take
question.
care. Okay.
Thank you. Take care, sir.